Great. Well, good afternoon, everyone. My name is Debbie Johnson, and I work with the community engagement team here at Johns Hopkins Federal Credit Union. And so thankful that you're able to attend today with, like I said, our friends in the room and our friends online. We have a wonderful panel of speakers today that will be discussing all different arenas of home buying and what that means to you. So you're going to be learning a whole lot of information today, a lot of resources as well. This is so important in today's climate that we are armed with as many resources as possible. So I mentioned before, actually, I don't think I mentioned yet, this is going to be recorded. Obviously, you knew that, so that'll be available sometime next week as well as the slide deck. I do have someone that is monitoring the chat and the Q&A. I'm going to go ahead and move this slide forward here. So a little bit of housekeeping. Like I mentioned, we do have the Q&A open, and we would just ask that you submit general questions that pertain to the group in the Q&A. And then the personal type questions, we will be giving you the resources as far as emails and contact information of all of our expert speakers today. General questions will be answered verbally, time permitting. And again, we're kind of moving on. We have 4 speakers today. We are changing it up with the order of the speakers. So our last speaker will be Betty from our Johns Hopkins Federal Credit Union mortgage team. So we ask that you stay on until the end of the sessions here. So a little bit information on our speakers. Of course, I mentioned Betty Freert. She is our VP of Real Estate Lending at the credit union. She has been with the credit union for a good long time, and she'll give you a little bit more information on herself. Again, she's our last speaker of this session. And then we have Wingrove Linton that's going to be kicking us off with our presentations today. And he's a realtor at Keller Williams, and his information is on the slide. And then we have Jeremy Hornberger, and you might recognize her as well at Work Life programs. She is at the Johns Hopkins University Benefits and Work Life with the Live Near Your Work program. And then Jordan Klump, he is a business relationship manager at Live Baltimore. So with that being said, I'm going to go ahead and throw it to Wingrove.
Good afternoon, everybody. Thank you for coming and thank you for having me, Johns Hopkins Credit Union. So I'm going to be talking about kind of like a home buyer's guide. So a first-time home buyer guide to the process and what you should be looking for when you're buying a home. So I'll introduce myself and who I am and why I'm here. And then I'll talk about why homeownership matters, common first-time home buyer myths, what agents actually do, the home buying journey, and we'll end with choosing the right home and what's important to look for when doing so. A little bit about me. I was born and raised in Baltimore, went to Maryland for college and came home and started real estate about 9 years ago as an agent here in Baltimore. I actually sold my first house right here in Canton 9 years ago. I founded the Grove Group about a year ago. The goal is just to help folks build wealth through real estate and find a home and for themselves and their family. I also am in the top 5% of all KW agents in the DC, Maryland area, and I'm happy to help anyone looking to make a move in the area. So why homeownership matters. My first point here is about equity. So real estate really is a tool, an investment tool that you can use to build equity for yourself and your family. And what does equity really mean? That looks like using the home as a forced savings tool, right? Where you're paying into this savings account every month, year over year, and over time you'll have a nest egg that you can sell or pass on and use as a way to save money. It also provides stability as opposed to rent, where the rent can and usually does go up. The mortgage is typically fixed. So you'll have a 30-year term, a 15-year term, a 10-year term, but that interest and principal payment is typically fixed so that you can budget accordingly and know you have this much to spend per month on the mortgage every month. There are also tax benefits. So you have the interest on the mortgage that you can write off at the end of the year, and that can be a savings as well. And then finally, the idea of renting equals paying someone else's mortgage, right? So when you're renting, you're either renting from someone else, civilian, or you're renting from a business, right? Either way, you're paying their mortgage down. You're not paying into that forced account that I was mentioning in terms of saving money that way. And it doesn't even really take into account appreciation. Typically, homes appreciate in Maryland about 3 to 5% a year, depending on where you buy. So if you're in a home for, let's just say, 5 years on the low end, there's about 15% of appreciation that you're going to see over that 5 year term and 10 years and 15 years. And you can see how that can compound. And just by living in the home and making the payments, you're increasing your nest egg and your wealth that way. So these are some common first-time home buyer myths. So Betty will talk more about this at the end, but the need for 20% down. Often I have clients come to me and say, do I need $100,000, $50,000? And what we do see now is that there are programs where you can put 3% down, 5% down, even some 0% down programs. And also Jordan will talk about, and Jeremy will talk about grants that you guys can use to apply to these, and that can go towards closing costs. It can go towards your down payment. And so you might not need, in some cases, any money at all. So the need for 20% down is just that. It's a myth. There are tons of ways to get into a home for significantly less than that. The second one is waiting for the perfect market. A lot of folks ask me, is now a good time to buy or sell even? And, with rates being where they are, is now the right time? Should I wait? Should I time it better? And my answer to that is always the right time is when you are ready. Some folks will look at where we're at now, rates are in the low sixes, and say, okay, they were 3%, 5, 6 years ago. Was that not a better time to buy when rates were lower? And what I tell them is that back then when rates were in the 3% range, we were seeing a lot of multiple offers. We were seeing homes selling for 10 to 15% above list price. People were waiving home inspections. They were waiving appraisals. So there is always a pro and con to every situation. And really, it just depends on your situation and specifically to understand when the perfect market is. And finally, here we have your first home should be your forever home. And this isn't saying that you shouldn't love your home or like the home that you buy. What this is trying to get at is you have to start. You have to start with the investment. And most folks are in their home for 5 to 8 years. So typically, the home that you get, that first home, will not be your forever home. It might be an investment property. You might say, look, I'll be here for 5 years and then I'll rent it out. I'll give it to my kids when they're looking to do something. There are tons of options there, but the key is start with what fits your life now and then build from there as you go. And this is a quote from Franklin D. Roosevelt. It reads, "Real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world." And this to me just speaks to the idea of it being an investment tool for yourself, for your family, and for the future. When you see stocks being so volatile and the dollar being volatile, the housing market through ups and downs has stayed pretty stable and over time does appreciate and is a great way to safeguard yourself and your money in uncertain times. So what do agents actually do, and how do they get paid? I bring the paid portion up here because there's been a lot of changes in talks in the news over the past year about commissions. Historically, the understanding colloquially was that the seller would pay the buyer's agent's commission, right? When you're buying a home, typically you have an agent and you have an agent when you're selling a home. And there's a lot of talk and a lot of lawsuits around that idea because sellers on the grounds that they thought they had to pay a buyer's agent, decided to sue the Realtor Commission and different brokerages around that fact. And sellers wanted it to be clear they did not have to offer a buyer agent commission, and that was a choice that they were making. And so now in the new climate, sellers are not required, they were never required, but are still not required to pay a buyer's agent commission. What I will say as a first-time home buyer, as a buyer entering the market, we are still seeing sellers paying buyer's agent commissions. I have two examples to give. One, I have a client that just got under contract a couple weeks ago in Reisterstown, and there was a multiple offer situation. There were actually 12 offers, including ours. And in that situation, the seller is still paying my commission. Just now in Canton, we got under contract on Wednesday, three different offers on a home on Streeper, and the seller is still paying my commission. And I've sold at this point probably about 25 to 30 homes since that change happened. And in every single one, my buyers haven't paid my commission. So I would always advise you to ask your agent. It differs house to house and deal to deal, but more often than not, we are still seeing that trend of being able to negotiate in that you don't have to pay for the buyer's agent's commission there. So this first bullet point here is act as your fiduciary. And what does that really mean? It means that agents are required by law to put your needs as a buyer or seller in front of their own. They are there working on your behalf to get you to where you want to be. That is one of the most important pieces of this whole entire thing, is that we are there for you. Also, understanding the local market is extremely important. I'm licensed to sell property in all of Maryland, but there are some areas of Maryland I just don't go to just because I just don't know the area. I don't feel comfortable advising my clients. I wouldn't be acting as a fiduciary in a neighborhood that I don't know. If I don't know the school districts, if I don't know pricing, understanding the local market is one of the keys to being a effective and good agent, and also knowing who works in the area. Part of that local market is who's doing business in the area, what agents are selling in the area, being able to talk to folks on the ground and understanding who's actually doing the business can go a long way to getting that offer accepted once you make one. Also, analyzing and comparing properties and understanding market trends. So an agent should be able to tell you, okay, this house is priced at $300,000 and here's why, based on what's sold in the past 6 months, based on bedroom and bathroom count, based on finishes. They should be able to break that list price down for you and say, hey, it's priced high, it's priced low, and here's why. Also negotiating offers. This is extremely important because there are a number of different levers that you can use to make an offer stronger or weaker. And an agent should be able to understand those levers and help you make the best offer possible based on your situation. Like, for example, the house that we won that had 12 different offers, we made some inspection changes. We didn't waive the inspection, but we put in a cap on inspection repair requests. So I felt more confident that we wouldn't be nickel and diming them for small things, but the buyer felt protected that they could ask for things if it was a major issue. So there are ways to make your offer stronger that you, as a normal civilian, wouldn't know, or some agents don't even think about. But a good agent will be able to help you through those things, and then managing the inspections and contingencies. So that's the idea, that there are tons of different timelines that you have going on, a lot to keep track of. And an agent will be able to walk you through that, keep track of those things, and make sure you don't feel overwhelmed and you're still enjoying the process, because it can be stressful at times. So this will just break down the home buying journey. Identifying your needs and wants and getting pre-approved, to me, go hand in hand. One of the first steps, and I'm sure Betty will talk about this in a little bit, is to get yourself pre-approved, to understand what you can qualify for and how that relates to your needs and wants. You want to make sure that before you look at anything, before you even go on Zillow and start dreaming about the home that you might want, you want to know that, okay, if I put this much down, this is where I can afford and this is where I'm comfortable. You also want to identify an agent pretty early on in this as well, because they'll be able to help you say, okay, look, if I can afford $300,000 or $200,000, how does that relate to locations? How does that relate to where I want to be? What are my needs and wants? And can I even get that in these neighborhoods at that price point? And thirdly, there is touring homes, which you get to the fun part of like, okay, I've identified locations, I've identified what I'm looking for, identified my price point, what homes match with that criteria. And then you go to making an offer. And that depends on the house. Every offer is different, every situation is different. There might be multiple offers, there could be just you, which is always ideal. But your agent will walk you through the contract process and hand in hand with your lender and make an offer that is suitable and strong. Finally, once you're under contract, you have the home inspection and negotiations. So the home inspection, the inspector will go through the entire property with you. You'll get a full PDF report back and it'll say, look, this is the age of the roof, age of the HVAC, age of the electrical. And we can go from there and say, okay, this house visually is what I liked, but now we're getting into the weeds of it. Are there issues? Are there things that we don't like? Can we ask the seller to address certain things, maybe get a credit towards certain things? So there's almost like a second, not almost, there is a negotiation that happens after that once you're under contract during this process. You can kind of help get more money or help get repairs. And then there's the appraisal where the bank will come in and verify that what you have agreed to pay is what they think the house is worth. And finally, you have closing where you get the keys and sign the final documents. And this typically happens about 30 to 45 days from getting under contract, sometimes a little bit longer, sometimes a little bit shorter. Um, if you're using grants, I'm sure Jordan will talk later about how that might affect your timelines because sometimes money needs to come in at a certain time, sometimes 15 days after and things like that. So closing, you kind of want to have all those ducks in a row so you can schedule closing within the appropriate time frame there. Second and final quote here is from Maya Angelou, and it says, "The ache for home lives in all of us, the safe place where we can go as we are and not be questioned." And this idea, I know I kind of harped on the home as an investment tool, but it's also a place to feel safe and secure, and it's a huge part of why I do this is to help people get that safety and security that they're looking for. So this here, final slide is about choosing the right home. First one is budget. When you get qualified, you'll have a range and you'll have like a maximum payment, and you want to make sure that what you're looking at budget wise is a long-term goal, right? What is your 5-year plan? What is your 10-year plan? How does this mortgage affect that? And where does that fall? Because you don't want you to be house poor where everything you have is going towards the house and you can't afford to go out and have a nice dinner or go on a trip. Location versus features. What I mean by this is that a lot of folks, especially now, are looking at HGTV and looking at Zillow and seeing these amazing properties, and they get caught up in the finishes in terms of an awesome bathroom with, rain shower or granite countertops or quartz countertops and crazy kitchens. And sometimes they might overlook location a little bit to get those things. And what I suggest to my clients to at least consider is location is one of the most important things about a home. You can't pick it up and move it, right? You can put in a new kitchen, you can put in new bathrooms, but you can't move the house. And that really leads into resale, right? Where you're looking at, might this home appreciate in a way that a home in a different location might not? And you can weigh that out. And some folks, to them, the features are more important. They say, look, I'll be there forever. I don't really care. I just don't care as much. I want to have a house that's just turnkey and done. That's perfectly fine. It just really depends on you and your situation. But as far as resale goes, looking at schools, looking at walkability, looking at amenities, right? Even if you don't have kids or don't plan to have kids, again, folks are in the home on average from 5 to 8 years. So odds are you will be selling this home at some point, and you should be thinking about, okay, what are other people looking at? What are they looking for that I might not care about, that they might? And that can help inform your decision on buying a home, and then helps when you call me again in 5 years to sell it. Like, hey, why is it not selling as quickly, right? Condition and age of home. There's something I also point out to my folks in terms of looking at the kitchen versus the big items like an HVAC system or a roof, right? Often homes that are renovated, or even lived in, but mostly renovated, they look shiny. People will come in there and they'll touch up the kitchen and touch up the bathroom, but they might leave an old HVAC system. They might leave the roof because it's workable, but it's old, right? And you want to look at that specifically because the cost to replace a roof could be $10,000, $15,000. The cost to do a new bathroom could be $10,000 and $15,000. And most folks would prefer to customize a bathroom than to put on a new roof, right? And so when you're thinking about those things in those terms, you really should think about condition and age versus finishes. And might you prefer to put that money into customizing a kitchen and doing it when you want to versus placing an HVAC system or a roof? And then condo versus townhouse for single family. All of these things have pros and cons. Condos, you have typically a front desk, a little more security, but you have condo fees. Townhouse, most often you have lower utility costs because you're sharing walls, but you don't have a big yard. Single family, you have a lot more to take care of. So every one of these things has its pros and cons to it that you have to just weigh with your goals. And then future development. That one is just talking about, okay, if I'm looking to buy a house in Reservoir Hill, for example, a neighborhood in Baltimore where there's a lot of development happening around it, might that positively affect the long-term value of the home, right? So thinking about what's around, or if you don't know, asking your agent, hey, what do you think this neighborhood is going? What kind of direction do you think it's heading into? What are you seeing sales-wise over the past 5 years? Can you forecast a potential growth here that would be helpful for me and my situation? And so thinking about that and not thinking about the here and now, um, is also important. And yeah, this is my information. So if you all have any questions or you want to ask something more personally, this is my cell phone number, email, Instagram handle. Happy to help any way that I can. So yeah, that's it. Thank you for your time today. Question?
No question.
Cool.
Okay, I think that means I'm up.
Yes.
All right. Good afternoon, everybody. Appreciate you coming out and appreciate again Hopkins Credit Union for having me. My name's Jordan. I'm with Live Baltimore. And I have a fun job today because I get to tell you about all the wonderful down payment assistance and incentives that are available in Baltimore. So a couple caveats before we get going on this. This is going to be Baltimore City specific. So we're looking at what we do at Live Baltimore and what all these programs are for is for Baltimore City. So they end at the city limits. If you're interested in other counties or sort of the metro region at large, there is down payment assistance out there. There's statewide programs, there are other programs in different areas. Lenders have different programs. So what I'd recommend to you in that case is working with someone like Betty or a lender that is familiar with the market is going to be your best bet for exploring those options, but also for getting through these as well. But let's dive into it. We're going to be talking about Baltimore City incentive programs, and the good thing is Baltimore City has the best homeownership incentives in the country. There is so much money available. If you are at all thinking about buying in Baltimore, now is a beautiful time to do it. And so what we're going to do is we're going to start by going over the general criteria, the things that are going to apply to all of the programs. And then I'm going to give you just a bird's eye view of the most popular city programs. I'm not covering everything today, and I'm not going to get into too much of the specifics. I don't expect you all to remember everything that we're talking about today. However, a couple things to take away. First one being Live Baltimore is here for you. We have a website with all of this information. We have full-time staff with all of this information. If you are thinking about these programs, you can, of course, lean on us. We're a nonprofit. It's a totally free community resource. And then again, working with an experienced local team can be really important. All right, so let's get into it. 5 things you must know for all of the Baltimore City incentive programs. The first one is the most important thing I'm going to say all afternoon. So if you take one thing away from this talk, now is a really good time to pay attention. And that is homeownership counseling. Always, always, always 100% of the time required. If you are using any Baltimore City incentive, you must do homeownership counseling, which is a 2-part process. There's a group workshop, and then there is a one-on-one counseling session. And you have to do both of those things in order to get your certificate. And you need that counseling certificate in your hand before you write an offer on a home. Okay? If you don't have the certificate, or if you did the first part, haven't finished the second part, you get excited, you find that home that's on the market, you go out and you need to make an offer that day. Well, now you're not eligible for any of the incentive money, because you have made an offer before having that certificate. So 9 times out of 10, when people have problems using these programs, it boils down to homeownership counseling. And so I really do recommend that you do that as soon as possible. If you're thinking about buying in the next year, there is zero disadvantage to doing it right now, because that certificate is going to stay good for 12 months. Okay. So if you're looking at buying in the next year, do this immediately. Go on, sign up for a class. There are 13 different city-approved agencies you can take counseling through. It's a pretty low commitment. It's like a 6-hour group class and then a couple hours with one-on-one with the counselor. It's free, and you'll thank yourself later when you get into all the other fun stuff with home buying that you've got this done and in the books. All right, so that's counseling. You got to do it. Please do it. Please do it first. Please do it immediately. The second thing is you have to intend to live in the house you're buying. So this is only going to apply to something called primary residences. Your primary residence is where you live. That is where you sleep at night. So you got to be buying a house that you are going to occupy. These programs will not work for rental properties. They will not work for investors, vacation homes, anything like that. You got to be living there. And then also you have to contribute at least $1,000 of your own money. That is a very low bar, but the city wants to see that you've got some skin in the game. And so there is a requirement that you have put in at least $1,000. So we'll sometimes get the question, how much money do I need to buy a house? At least $1,000. The minimum is you have to have $1,000 of your own money. Good news is, like I said, that's pretty low bar. Your earnest money deposit is going to count towards this, and majority of the time it's over $1,000 that you'll have to put down as a deposit. So no worries there, but you do have to have some skin in the game. All right, so we're going to talk about some programs that are based on employment. Jeremy, in just a moment, is going to share information about the Live Near Your Work program. And for any Hopkins employees on the call or in the room, Hopkins has the best Live Near Your Work program in the city. So you've got really a lot of money on the table available to you if you're looking to take advantage of that. There's also a Baltimore City employee incentive we'll talk about. And then some of the programs are restricted by household income. We'll dig into that a little bit more when we get there. For me, I'm only going to be talking in specifics about the first-time homebuyer incentive, which is income restricted. But there are other programs out there that have income limits. And so you'll want to work with your lender to see what you qualify for and make sure you're keeping that in mind. Then the other thing I'll say is the flip side of that there are plenty of incentives that aren't restricted by income and aren't based on employment. So there's something for everybody in Baltimore. We have a ton of programs, and so commend y'all for being here and getting the education. That's step 1. Step 2 is just go out there and get after it. And we're going to help you. We're going to arm you with some information to let you do that today. So first terminology piece that we want to define is first-time homebuyer. First-time homebuyer, for the purposes of the city program, is a little bit broader than you might think. It's anybody that hasn't owned property in the past 3 years. So it's a 3-year look-back period only. If you owned a house longer than 3 years ago and you sold it, and let's say you've been renting ever since, you are considered a first-time homebuyer for the purposes of the city incentive. And then also really important to understand are these three terms that I've got on the board here. Sometimes people say grants to apply to all of the homeownership incentives, and it's not always the case. There are certainly different strings attached, and in some cases, repayment terms attached to this money that you're getting. So you don't want to think about any of these dollars as free money that we're about to talk about. It's really important to understand what terms and what strings are attached to receiving these funds. So the vast majority of the programs in Baltimore City are going to be in this left-hand column, which are known as forgivable loans. And the way that a forgivable loan works, and in our case here, we've got a 5-year forgivable loan. The way that works is when you close on your house and you get that money to help you buy the house, you then are creating a lien on your house in that amount. So it's a loan that's actually attaching to the house in that amount of money, whatever amount you've received. But it functions differently than loans you might be used to in that you're not making any payments on it and it's not accruing interest. In fact, the opposite is happening. With a 5-year forgivable loan, 20% of that amount is being forgiven for every year that you live in the house. So let's make it easy. Take an example. Let's say you've got $5,000 as a 5-year forgivable loan. That means that you live in your house, and for every year where that is your primary residence, $1,000 is coming off of that loan. 20% is being forgiven. Until you've been in there for at least 5 years, the loan is fully forgiven and extinguished. And you haven't made any payments, it hasn't accrued any interest, nothing like that. However, you can trigger repayment of those amounts if you've got a forgivable loan. And the way that happens is if you move, you sell the house, or it is otherwise not your primary residence, then you're going to trigger repayment immediately of whatever amount has yet to be forgiven. So again, take our example, $5,000, 5-year forgivable loan. Let's say 3 years into it, you got a new job, you have to move. You would then have to pay back $2,000, the amount that's remaining on that forgivable loan. If you stay in the house for 5 years or longer, then it's gone. Then it's fully forgiven. You do not have to ever think about it again. The lien is extinguished. And then if you move out or, turn it into a rental property, whatever you're going to do, you wouldn't have to pay any money back. The next type of incentive program is something called a deferred loan. Deferred loans are very similar to forgivable loans with one important difference. Just like with a forgivable loan, you're creating a lien on the house in the amount of the money that you're receiving. And just like with a forgivable loan, there is no interest being accrued and you're not making any payments on it. However, a deferred loan truly is a loan and you have to pay it back eventually. Whether it's 5 years from now, 10 years from now, 30 years from now, when you pay that mortgage off, that money has to be repaid. It does not go away. As soon as you either move out, sell the house, whatever, or pay your mortgage off, the deferred loan becomes payable and you have to pay that as well. So really important. Again, these are great. Both are fantastic, especially with a forgivable loan. If you're staying there for at least 5 years, there's no downside. It's awesome. With a deferred loan, they're still really helpful because you get to use $1 today, which is going to be worth more than $1 down the line when you repay it. And it helps get you to that closing table. But it's really important to understand the strings attached and what you're getting yourself into. And that's why I like to break these down. And then certainly last but not least is grants. True grant. These are the best. You can think of this like a gift. There's no lien. There is no repayment. You could buy your house on a Tuesday, sell the house on a Wednesday. You would not have to pay that money back. So grants are true grants, as they're sometimes called. They're the best, and that has zero repayment associated with it. All right, so that's sort of setting the scene. Now we're going to jump into the specific programs. And again, I'm hitting these high level. I'm going to be throwing a lot of information at you. You do not have to memorize it. Just know that this is out there and that if you want to take advantage of it, we are here to help. All right, so the first one is called Buying into Baltimore. This is one of my favorites, and I'm only a little bit biased here because I do work at Live Baltimore. But this one is the $5,000 that you can get if you attend one of our trolley tour events. It's a really, really flexible incentive because it is not limited to first-time home buyers. There is zero income requirement or restriction, and you can use it anywhere in Baltimore City. It's not based on specific neighborhoods or geographies. And what it is a $5,000 5-year forgivable loan if the timing works out and you're able to attend a trolley tour event and sign your contract within 12 business days after the trolley tour. So we do 3 trolley tour events per year. These are totally free events. They're really great. If you're looking at buying a house in Baltimore City, I highly encourage you to check one out or multiple. What we do is we put you on a coach bus and give you a bus tour of Baltimore City neighborhoods. We have educational workshops happening throughout the day. And there's also an exhibitor fair where you can talk to different agents, different lenders, title companies, insurance professionals, home inspectors, you name it. Anyone that you would need to talk to in this process of purchasing a home, we got them all in one place for you. So it's great. You can come and check out the event. The next one is going to be on May 3rd. It's a Saturday morning. Again, it's free to attend. How you get the $5,000 is you can't have an offer on a house before the event. So you have to go into the event without having made your official offer. You attend the event, and then you have 12 business days to go out, find your house, get under contract. And if you're able to do that, and that's 12 business days, not 12 days. So you got 3 weekends, 2 full weeks, and a couple extra days to get under contract. If you're able to do that, you apply with us and we put you in a lottery to get one of the $5,000 awards. We have 20 of these that we distribute each time we do the event. And again, the event's 3 times per year. So sometimes when I say lottery, people think, well, is it really worth my time to go after this? Your odds are about an 80% chance. 80% chance of getting $5,000 if you go for this one. So I really encourage you to think about it. If it works for your timing, give it a shot. We do trolley tour every winter, spring, and fall. So next one's going to be on May 3rd. Following event will likely be the first Saturday in October. So think about that. If it works for you and your buying timeline, it's a great way to get some extra money. Next city incentive is the first-time homebuyer incentive. This used to be called CDBG, is now called the first-time homebuyer incentive. And as you might have guessed from the name, it is Baltimore City's incentive for first-time homebuyers. I will give you a caveat on this one that we have a meeting next week to talk about a new updated program. So these criteria, the eligibility might be shifting a little bit starting next week. But as of now, here's how it works. It is a $10,000, again, 5-year forgivable loan as a base, and then you get an extra $5,000 if one of 2 things are true. If either you're purchasing a home that you've been renting for at least 6 months, or if you are disabled or caring for someone who is disabled. If one of those 2 things are true, you would get $15,000. If you don't fall into either of those criteria, you would get $10,000. It is for first-time homebuyers. So again, remember that means you can't have owned a home in the past 3 years. It is income restricted. So I'm going to put up a chart to show you some of those numbers, but your income cannot exceed 80% of the area median income. And it requires you to do something called a Housing Quality Standard, or HQS, home inspection. The HQS home inspection is very similar to your regular old run-of-the-mill home inspection. It costs the same. It takes the same amount of time. However, the big difference is the house is either getting a pass or a fail grade at the end of that HQS, and you have to get a pass grade in order to use first-time homebuyer incentive. And so what makes a house pass or fail? Well, it pretty much has to be livable. There can't be any major safety issues like lack of heat or roofing, the roof is missing, or there's foundational structural issues, something like that. So practically what that means is this one isn't going to work if you're trying to do a fixer-upper or a renovation product. It pretty much has to be a move-in ready home. And then again, there is an income criteria on it. this chart gives you a breakdown of some of the income restricted programs. We are not going to talk about FHLB or Maryland Mortgage Program today, but I know that the Hopkins Credit Union can do FHLB, which is really awesome. That's another great program. You can get potentially $20,000 there if you meet their criteria. So encourage you to look into that one a little bit more. But for the purposes of first-time home buyer, we're up at the first row of this chart. And the way that the chart works is you look at how many people you have in your household. That's people, so adults and children. Trace that down to the first row, and that is the gross income that you have to be at or below in order to qualify. So that includes everything, not just your W-2s. It also includes everyone that's living in the house. So if you've got relatives living with you, collecting SSI or other benefits, child support, alimony, all of that gets factored in. And so just to give you a sense, we put this chart up to see if this is something you might qualify for. Again, your lender is going to be a wonderful resource in evaluating income and all of these programs, but they have tools to help screen you for these types of things. So reach out to Betty or reach out to your lender, and they're happy to help with that. All right, moving on. Next program is the Vacants to Value Booster. So Vacants to Value, or V to V, is a $10,000 5-year forgivable loan. It is not income restricted. It is not limited to first-time home buyers. What this one is for is properties that were formerly vacant. So if you are buying a house that used to be a vacant property and had something called a vacant build-in notice for at least 12 months, you will get $10,000 as a 5-year forgivable loan. And there's two ways to use it. You can either buy a vacant that's currently vacant and do all the renovation work yourself. You can get a renovation loan and put the elbow grease in and turn it into a beautiful new home. That's great. And if you are up for that challenge, more power to you. But the second way, and probably the more popular way, is to purchase a home that was formerly vacant where a developer has already done all the work for you. And in that case, that $10,000 goes to you, the person that is buying the house to live in it. It does not go to the developer. It goes to the home buyer. So the reason that we have this little note on the bottom that says, anytime you buy a recently renovated home in Baltimore, ask the Office of Homeownership if it qualifies. It's because there are a lot of developers out there doing this. It's built into their business model. It's built into their strategy. Baltimore's making a really concerted effort and making a lot of progress in turning vacant properties into new housing stock and putting it back in productive use. So it is always worth the 10-minute phone call to the Office of Homeownership to see if that renovated, beautiful home that you're purchasing in Baltimore qualifies for this program, because you never know. You could end up getting $10,000 towards your purchase. So it's really great. It's sort of a property by property type of eligibility scheme. So you want to work with a realtor that can help track these down for you if this is something that you're interested in taking advantage of. All right, Baltimore City Employee Homeownership Program. This one's really easy. If you work for the city of Baltimore or a quasi-city agency, you get $5,000. That's it. You have to be on the job for at least 6 months, but as long as that is true, you get $5K. What is a quasi-city agency? These are things like Baltimore City Public Schools, the library, a lot of the museums qualify. We have a list on livebaltimore.com if you're interested in checking that out. You can also check your pay stubs or your paychecks. You see Mayor Scott's name and the seal of Baltimore on there. You probably either a city employee or a quasi-city agency. All right, and then buy back the block. This one's also a favorite of mine. Again, only just a little bit biased here. It's a $15,000 if you're using a purchase only mortgage, or $20,000 if you're using a rehab loan or anything with finance renovations as a true grant. So remember, that means zero lien on the house, zero repayment. You get this money, it helps you buy your house, and then you don't have to repay it ever. The way this one works is it's an anti-displacement strategy. It is for residents in the city who are buying in the city. So if you are living in the city, you've been there for at least a year, and you were looking at buying in the city, I highly encourage you to check out this website, livebaltimore.com/BBB, to see the map of where the eligible areas are, as well as take an eligibility quiz that can help screen you for eligibility and get you in touch with our staff that will help you work through this program. You do have to be in an eligible area. It's something called a qualified census tract, and it's about 150 or something neighborhoods in Baltimore that are within a qualified census tract. So it's a big chunk of the city. It's a majority of the city. But check out that website if you think you might be eligible or interested. There is also an income limit, but as you can see, the income limit is pretty high. It's it's higher than the 80% AMI. It's higher than FHLB. You've got a lot of wiggle room there. All right, important funding information. So for all of these incentives, there's a limited amount of funding. The city budgets a certain amount every year, and once they're used up, they are used up. So it's important to keep an eye on that. Have your lender keep an eye on it. Have your realtor keep an eye on it. There's a tracker online that you can check out. These numbers are not current. This is just an example of what the tracker looks like. You would go on the Office of Homeownership's website to get a look at that. And then the replenishing happens July 1st of every year. So when the city's fiscal year turns over, the new budget comes out, that is when we have more funding available for the incentives. The one exception here is Buy Back the Block. That is through Live Baltimore, and it's only here until the end of 2025. So if you're looking at using Buy Back the Block, I would encourage you to do so as soon as possible because it's only around until the end of this year at the latest. And if we run out of money, it could even be before that. So reach out to us, check out that website, and we'll help you out there. And then last thing to keep in mind is it does take some time to actually get the check for these incentives. So the city is still doing paper checks. It has to go through multiple different administrative agencies. It takes up to 15 business days for that money to be available. That's business days, that's not just days. So that's, weeks of your time. And as Wingrove mentioned, the closing timeline is different in every transaction, but it's something that you're going to have to pay attention to and make sure you're setting a realistic expectation and timeline for yourself. Because if you're using these incentives, you need to allow yourself enough time to actually get the check. A 30-day close is tight. That is the absolute fastest you can do it. And even then, it's going to be tough. You have to get your application in immediately, have all your things together, make sure you get approved without any speed bumps, and then wait on the check. So realistically, if you're using these incentives, especially if you're using multiple, which we're going to talk about in just a minute, you need to have some time built in. You need to have probably a 45-day close, or at least have some contingency written into the contract that's going to protect you in the event that things get delayed. But again, working with a stellar realtor, or real estate agent is the way to go there. And I would recommend you work with somebody that has experience with these programs, so you're not anybody's guinea pig, and they can actually help you through the process. All right, so I mentioned stacking incentives. The big reveal, my favorite slide. These programs are not exclusive. You can use as many as you qualify for. They all work together. They all stack together. So as you can see, this is a real customer that reached out to Live Baltimore that we helped get some of these incentives. And Molly certainly filled the bingo card, but look at what happens when you can qualify for multiple programs. Molly got trolley tour, live near your work, first-time home buyer, vacants to value, and then used a Maryland Mortgage Program loan and ended up with $40,000 in down payment assistance when she went to close. That is all of her closing costs. That is pretty much all of her down payment. She just has to bring that $1,000 of her own money, and she's having a real good day when she goes to pick up her keys for that transaction. So we show you this, and oh, by the way, Hopkins Live Near Your Work in many cases is higher than $5,000. So you could even get more than this if you qualify for multiple. So but I do show you that not to set the expectation that you're going to get $40,000 in down payment assistance, but just to encourage you to know that this is out there. This money is out there for all of you right now. We know that probably the biggest barrier to purchasing a home is the down payment, is having the money up front. And you do not need 20%. You do not need to have $40,000 saved, $10,000 saved, $5,000, because these programs are going to help bridge that gap. You absolutely can do it. And even if you get one or two, just think about that. Think about how much closer you would be to that home purchase if you had an extra $15,000, $20,000 in down payment assistance. And speaking of down payment assistance, we've got one more that we haven't covered yet, which is the Live Near Your Work program. It's an incredible program. As I mentioned, Hopkins has a really, really awesome Live Near Your Work program. And to tell you a little bit more, I'm going to toss it over to my colleague, Jeremy.
There's a question in the chat.
Yeah, sure.
And the question is, where can we find the sign up for the first time homeowners group class you mentioned? And does this expire ever? If we did it now, but don't put an offer down for 12 to 16 months.
Yes, two really good questions. The first one is livebaltimore.com has a full list of all of the Baltimore City approved counseling agencies. So you can go to our website, livebaltimore.com, and just search homeownership counseling, and you'll find, there's 13 different organizations you can take this through. So it's up to you, whichever one works with your schedule. You can check that out. Also, you can just Google Live Baltimore Homeownership Counseling, and that page will pop up as your first result. So that's where I would recommend finding your homeownership counselors. And then the question on expiration, that certificate is going to be good for 12 months after you receive it. So if you are looking at purchasing in the next 12 months, I would say go ahead and do it now. Even if you're looking at 16 months, I still recommend doing it early for a couple of reasons. One, things can go very quick. You might, get your counseling, get your pre-approval, and then find the house that you really want within, shorter timeline than you expect. That happens all the time. And in that case, you would rather have your counseling certificate in hand than have to hit the brakes and, do that before you can move forward on a home purchase. So, and the other thing is sometimes you can get a counseling certificate renewed without having to go through the full process again. So that is possible. It sort of depends on the organization. And if you've got more questions about that, you can reach out to us at Live Baltimore. We'll give you some tips. But yeah, I would say, it's free. Homeownership counseling is free. And I always recommend you do it early. At the very latest, when you start talking to lenders, do your counseling at the latest, because I'll tell you, we've seen it so many times where people get to the finish line, want to put that offer in on the home, find the house, find their dream house. They want to get that offer in. They want this house so bad, and they can't do it because they have to do the counseling. Or worse yet, they put the offer in and then they miss out on so much money, $10,000, $20,000, sometimes more in incentives because they didn't do their counseling. So do it now, do it early. It does expire within 12 months, but still recommend as soon as possible. Yep. Any other questions? All right, perfect. Thank you.
Great. Hi, everyone. I'm Jeremy. I work at Johns Hopkins University. I am a work-life specialist in the Office of Benefits and Work-Life in the HR department, and I oversee our Live Near Your Work grant program. So for Hopkins employees, if you are a full-time benefits eligible employee, you are eligible for the Live Near Your Work grant. There is no probationary period, so the day that you start at Hopkins is the day that you can apply for this program. There's also no income eligibility on this either, so it really doesn't matter what tier you fall in, you are still eligible for this grant. Like Jordan mentioned, again, the homeownership course and counseling session is your most important first step. I just had someone lose out on our highest grant amount because they signed their contract 2 days before they did their counseling, and it was just heartbreaking. So I cannot emphasize enough to complete that. A lot of the agencies offer virtual options as well as in person. If in person isn't doable for you, you can do an online course. And then the property also for Hopkins has to be within our designated boundaries, and I'll show you a map on the next screen. If you don't work for Hopkins and you're listening today, I would definitely recommend going to the city website and searching which employers are a part of the Live Near Your Work program. It is a city matching program, so there's a number of employers that are participating. Some additional rules, which are pretty standard, we go off of the city requirements as well. The home must be your primary residence. The money that you receive from Hopkins has to be used towards your down payment and closing costs. You have to contribute 1,000 of your own funding, as Jordan mentioned. You have to finance with a mortgage loan. There's no cash sales that are allowed. You also have to be apply for and be approved by the city in order to receive Hopkins funding. And all of the information and additional rules and upcoming webinars are on our website as well. This is our boundary map. So that dark purple line, anything that falls within that line is going to be eligible for the Live Near Your Work grant through Hopkins. The purple blue shaded areas are our main campuses. The green is going to be our highest grant amount of $17,000. So that's $14,500 from Hopkins and $2,500 from the city. The orange are Remington and Waverly neighborhoods. That's going to be a $10,000 grant. So $7,500 from Hopkins, $2,500 from the city. And then everything else within that purple boundary is going to be the $5,000 grant amount. You can go on our website and use the map to enter which properties you're interested in, and it'll show you where on the map it falls so that you can see what you might be eligible for in terms of grant funding. The other thing to note is that Hopkins grants are taxed, and so the gross grant amount is what is listed in that second column from Hopkins. We do a tax calculation for all of our employees who are applying, and the net amount is what you are going to see in your paycheck. The city grant is not taxed, it's $2,500 every single time, and so then that final column gives you an idea of your cash to close, what you're going to be bringing to settlement. The grant amount, again, depends on where within the boundaries the property falls. Yeah, and city grants are not taxed. And then to talk a little bit about the city, so they also use Neighborly software, which is what Hopkins uses for our application. So it's a little confusing, but you do have to complete both applications, one for Hopkins. And once you're approved, you'll get an email from me with an employer verification form, which is necessary to apply to the city grant. I do find that a lot of lenders actually complete the city application for you, which is really nice. So you don't have to worry about that. But you do have to have your Hopkins approval first before you can do that. And we also mentioned earlier that the city can run out of funding. If they do, you can still receive the Hopkins portion of the grant. That doesn't impact what we're able to do. And just a quick note on the payment process and timeline. So if you do work for Hopkins, you're going to get paid via direct deposit through your payroll. We try to do it on the closest pay prior to settlement, but we can also run off-cycle payments. So if we are outside of a pay cycle, we can make sure that you still have your funding when you go to closing. The city, however, once you're approved by them, it takes 10 to 15 business days for the check to arrive in their office for your title company to pick up. So that's a pretty significant amount of time, which is why we encourage everyone to apply as early as possible once you have your offer on a home that's been accepted. Because the city funding cannot be used retroactively either. It has to be the physical check brought to settlement. So that's just something to keep in mind as you're going through the timeline and process. And then this is just some information on how to get in touch with me. That worklife@jhu.edu email address is going to bring you directly to me. So if you have any questions, don't hesitate to reach out. And all the information is also on our website. And I'll be hosting a webinar next month as well, going over more of the details and steps for application. And I will turn it over to Betty. Thank you all so much for your time.
All right, so I'm going to back things up a little bit because we've been talking our way through the entire process and gotten to closing with lots of money and a good realtor. So I'm going to back up and talk about what I think should be really your first step as you're preparing to buy a home. A lot of times what I experience, and I know, for example, Wingrove experiences, is people who have been thinking about and dreaming about buying a home, and they've gone online and they've looked at all of these beautifully staged houses, which I like to call real estate porn, and they've gotten some really high expectations. And then they talk to me and I say, oh, well, what you can afford is actually a house that costs $150,000 less than that, because they don't know. So it's best to, as your very first step, work with a lender, hopefully me, to get pre-qualified or pre-approved to buy that property, because that way you can set your expectations and not get disappointed. And to follow along with what Jeremy and Jordan were saying too, do that pre-approval and do your counseling before you go looking at houses. So again, you don't fall in love with something and then miss out on grant money. Okay. In today's market, virtually every realtor who is going to be showing you homes is going to want a pre-approval letter to know what you can afford, because they're going to need to submit that pre-approval letter with your contract in order for you to be taken seriously. All right. And it really doesn't take too much time. Generally, we spend about 15 minutes on the phone with people. We have them upload some documents to us. We do a soft pull on credit, and we can give them a letter that says, you can afford X dollar amount. Okay. So let's talk a little bit about what we're looking at when we're doing a pre-approval, which feeds into what you're looking at for formal mortgage loan approval. Okay. And I'm going to go way, way back to what they used to call the 3 C's of credit: capacity, collateral, and character. Okay. And I'm going to talk about collateral first. Collateral is basically the house that you're buying. Okay. And what that's like. I know Wingrove talked a little bit about buying for value, and that's certainly a component of it. We're going to be looking not only at the purchase price and the loan amount versus your income, but things like the property condition. If you're buying a home that has water in the basement, needs a new roof, and the roof is actively leaking, you turn on the lights and you get sparks, that kind of thing. Most lenders who are doing your standard loans are not going to lend on that property. They're going to say, no, sorry, our appraiser noticed all these issues, and those have to be addressed before you can go to settlement. So everything I'm talking about is about a standard loan where the property is in good condition. If you're buying a home that really has some significant issues, there are loans out there. The best known one is something called an FHA 203K loan. It is much more involved, a little more challenging. I recommend that you be very good at paperwork, have an understanding of home improvement and repair process, whether you know how to do it yourself or have someone who does, because you're going to be negotiating with contractors and getting inspections. The appraisal will be based on what the house will be worth after you're all done. So it's sort of a very different animal. All right, so I'm going to be talking about the plain vanilla. This house is in pretty good shape. And by that, I don't mean that it's necessarily the best house on the market. You can buy a very dirty house. You can buy grandma's old house that has the wood paneling and the avocado fixtures. All of that's fine. Cosmetic stuff is not an issue. Things that could affect safety, livability, the mechanical systems of the home, those are the things that are concerning to a lender. Okay, so let's talk a little bit about your capacity to buy the home. And there's a couple of things that fall into this. The first is, how much money do you have? And as Wingrove noted, you don't need a 20% down payment to buy a home. That is absolutely a myth. But your down payment is the difference between your purchase price and your loan amount. And requirements for the down payment are going to vary based on the property type, the loan program you choose, and sometimes your credit score. Usually the down payment minimum is 3 to 5% of the purchase price. So because I can't do math in my head, let's say that you were buying a house for $100,000. A 3% down payment would be $3,000. You get a loan for $97,000. Okay. We do offer 100% financing or no down payment for certain qualified first-time homebuyers and physicians less than 10 years out of residency. And I'll talk about that. Okay. The other monetary component here is closing costs. Okay, this is different from the down payment in that these are the fees and expenses involved with buying a property and getting a mortgage. Lender fees, lender points, appraisal, credit report fees, the title company fees, the fees that Maryland and the county or city charge for recording your mortgage. Okay. It could potentially include realtor commission. As Wingrove said, we haven't seen that very often. I have seen a couple where the buyer was paying some of the realtor commission. From what I've seen, that has tended to be more on the high-end properties where everybody's got a lot of money. But, you know, it's just something to keep in mind. Usually closing costs are going to be about 4 to 5% of the purchase price in Maryland. And it does vary a lot. A big component of it is what the property taxes are on the home. So I normally recommend, if you're tight on cash, we are very happy to run closing cost numbers on any house that you're looking at to give you a better idea. If you make an offer on this home, how much money would you need? Okay. Money for the down payment and closing costs can come from your own savings, including loans against retirement plans. They can come from gifts from relatives, and they can come from grant programs like the ones Jordan and Jeremy talked about, or a combination thereof. Sellers can also contribute money towards your closing costs. Sometimes you'll see a contract written so that maybe the buyer is paying a little bit more for the house, but then the seller is contributing some funds towards their closing costs, which lessens the amount the buyer needs to bring. That's not that common in this market. We do see it sometimes now. And your realtor would be the best person to talk to say, you know, based on the area where I want to buy, is having the seller contribute towards my closing costs a prospect? All right, another part of capacity is what we call the debt to income ratio. That's basically where we look at what kind of monthly payment can you afford. And what we're doing here is we're taking all of your monthly loan and credit card payments, alimony, child support, any other kind of legally mandated payment, the proposed mortgage payment, adding those all up, and then dividing them by your monthly pre-tax income. Okay, not take home, but pre-tax. And the result is your debt to income ratio. So a debt to income ratio of 45% or less is very well accepted by lenders. Some loan programs will go up to 50%, maybe even a little higher. But keep in mind, this is the proportion of your monthly income that is not in your hands because it's going to loans. I always tell people, just because I tell you you can afford it on paper does not mean that you're going to be happy with the payment. So, you know, let me tell you what the payment is projected to be for this house that you want to buy. And then just make sure that it fits into your own budget and you're comfortable with it. We really want you to be able to buy curtains and trash cans and go out to dinner occasionally. Okay, not be house poor. We don't want you to have regrets after the fact. So make sure that proposed payment really works with what you want. Okay. And just to plug here, we now have a financial counseling program, financial coaching program called Achieve. And we work with people to do things like pay down debt, help with budgeting, that kind of thing. So this is available for people. Obviously, you have a goal of buying a home. If you need some help to get where you need to be in terms of debt to income ratio or credit, just go to our website and look up financial coaching and it'll come right up. All right, then we look at character, okay? And, character, I don't know whether you're polite to your grandmother or you help people cross the street, but when I'm looking at character, what I'm looking at is, do I think that they're going to pay me back if I give them all this money? And I have very limited tools to assess this. The biggest thing we're going to look at, of course, is credit. Okay. And credit score requirements are going to vary depending on the loan program and the lender. The minimum credit score here at the credit union is 620. But if your score is as low as 620, probably we're going to need to be seeing some other positive factors to make up for that lower credit score, like I can make a bigger down payment, that type of thing, And just a warning, the score you see on all those credit scoring apps, including the one that we have, Savvy Money, is a projection. It is not necessarily the score you're going to see when you apply for a mortgage. So I always tell people, assume that that score you're seeing is higher than reality. So if I'm telling you that, FHA would be a good program for you, we need a 640 credit score for that, and your credit score on one of those apps is 640, assume you want to get it a little higher, okay, in order to not be disappointed. On an actual mortgage credit report, what we're doing is we're pulling scores from all 3 credit bureaus, and then we're using the middle one of those scores. So if you're checking your scores with the different agencies and one is significantly lower than the others, look at that agency's credit report, see what action you could take with the debts they're reporting, focus on that to get your score up. And if you had a prior bankruptcy, short sale, foreclosure, there's some additional requirements in terms of waiting periods for those. So I'd suggest you reach out to us and we can kind of go into that with you in more detail, just to make sure that we meet those requirements for you. The other thing I'm going to look at in terms of, are you going to pay me back, is how stable your income appears. Okay, so let's say that I've worked for Burger King for 6 months, and then I'm off work for a month, and then I get a job at Hopkins, and I work there for 8 months, and then I quit and I'm off for 2 months, and then I get a job as a bookseller at Borders. As a lender, what's going to happen is the lender's going to say, oh gosh, that income is all over the map, and there's months where there's no income being earned. I don't know that this income is something we can rely on. But, in contrast, let's say that I work at Burger King. I work there for 4 months. I get another job at Chili's, start right away, making more money, work there for a year, get another job at, I don't know, some other high-end restaurant, making more money, no gaps in employment. That's a totally different situation because that person is building their employment, building their income, staying in the same line of work. Okay. So the lesson I want you all to think about is that it's not that changing jobs is bad. Changing jobs can be perfectly fine. But what you want to be showing a lender is that there is a pattern and a progression to your income that shows purpose and that shows that you're not likely to suddenly be left with no income. Okay. Another example is, let's say I haven't been working, but I've been in school getting my nursing degree. And then I graduate and get a job as a nurse. Well, that's great. I might not have years of employment, but I've been engaged in something that's getting me the credentials to make money. Okay. Generally, lenders are going to look at, do we think this income is going to continue for about 3 years? Okay. Sometimes we have people, for example, who are getting child support for a 17-year-old and it ends when they're 18. We can't use that because it's going to end. Okay. And sometimes that can be an issue with fellowship or stipend income, if any of you are receiving that kind of income, because that has a defined expiration date. We do have programs that don't look at that, but it's just something to be aware of, particularly if you're looking at other lenders, that they may be saying, oh gosh, we're not going to use the stipend income because it's only going to last a year and a half. All right. And picking up on the fellowship and stipend piece, the credit union lends to borrowers on J1 and F1 visas, okay? With our membership basis, that's very common. Not every lender will. Some specifically exclude certain visa statuses. So that's something, if you're looking around for a lender, that you want to make sure that you understand what they'll do. Okay, now just a shameless plug for our mortgage services, because I, of course, think they're the best. All right, we offer a variety of loan programs, and I'll talk about those momentarily. Conventional FHA, VA. We have some low and no down payment programs. We work with a number of the home buying grants. We've got good rates, good fees. And what I think is the best thing about the credit union is that we really have personalized service. You deal with one person from start to finish, which is not the way mortgage financing usually works. You get handed off from the loan officer to the processor to the closer. And every time it can be a little bit of a wrench because the new person doesn't know anything about your situation. And some balls get dropped there. We don't do that. We're in the business of helping our members, not making commission. So that's a very different outlook. All right, so let's talk about mortgage types. The most common one is a conventional mortgage. With that, you have a 3% minimum down payment for a first-time buyer, and for certain income restricted programs available to folks who aren't first-time buyers, 5% down otherwise. And that first-time buyer is the same definition as Jordan gave. You haven't owned real estate in the last 3 years. Okay. All right. Otherwise, it's a 5% minimum down payment. A conventional loan has the strictest credit and debt ratio standards. Okay. However, it's the financing choice that is generally looked at most favorably by sellers because realtors know it has the strictest credit and debt ratio standards. So they know a conventional financing offer means the buyer is a little bit above generally. Also, very selfishly, some of the other programs have more repair requirements for the sellers, and conventional has fewer. So sellers like that. A conventional mortgage does require private mortgage insurance, which insures the lender if you don't make payments on the loan. As long as you're putting less than 20% down. However, with a conventional loan, that private mortgage insurance can be canceled at a certain point as you build equity in the property, so it can go away. All right. FHA, okay. FHA, 3.5% down payment, regardless of whether you're a first-time buyer or a repeat buyer. FHA is more forgiving in terms of credit scores and debt ratios. Particularly if you have a credit score, say in the mid 600s, you will often get better pricing and a lower monthly payment with FHA financing than you will with conventional. The downside is the mortgage insurance generally can't be canceled. The only way you can get rid of it is to refinance into another loan type. But that said, you know, it can be an excellent product to get you into a home more affordably than a conventional mortgage in some cases. Okay, then real quickly, VA. We don't do a lot of these because our membership group just doesn't, you know, lend itself to this. You have to have had prior or current military service, including National Guard. There is no down payment. There is no mortgage insurance. There is a funding fee, which gets added to the loan balance. Okay. And there's, again, like FHA, more leeway in terms of credit scores and debt ratios. So this is an excellent alternative for the folks who qualify for this. Okay. Now, we also have a couple of programs that are specifically created for our members that don't fit into those boxes. Okay, we have a 100% financing program, which has no down payment. It is for first-time buyers. We're going to want to verify that you've paid rent and all of your other credit on time for the past 12 months. The maximum qualifying income for the program is $150,000. We'll lend up to $500,000 with this program. A big benefit is there is no private mortgage insurance for this loan. And you can use gifts and grants to assist with your closing costs. So, you know, it's like the example that Jordan gave of that person who had all the money from the Baltimore City grants. Imagine if there was no down payment, you know, you could do pretty well. Likewise, we have a special program for physicians. No down payment. This one, you can also be a repeat buyer. You have to be either in residency or fellowship or less than 10 years out of residency or fellowship. No private mortgage insurance. This does require a 680 credit score, and gifts and grants can be used to help with your closing costs. All right, now I'm going to talk about some things that are important from your standpoint in helping your mortgage process, your home buying process go smoothly. First of all, don't make a lot of moves with your money between one account and another, okay? Anytime you make a deposit into one of your savings accounts or investment accounts, and that deposit is more than 50% of your monthly income, the lender's going to say, where'd that come from? Show me. You know, so if you transferred money from JHFCU to Wells Fargo, and then from Wells Fargo to Vanguard, and then from Vanguard to JHFCU in any kind of sizable amount, the lender is going to be asking for all of those statements, so, which is kind of a pain. So before you go out looking for a house, it's best in terms of cutting down on the paperwork for yourself if you put all your money where you want it to be and just leave it until after closing. Likewise, lenders are generally going to check your credit right before settlement to see if any new accounts have been opened or if there's anything adverse. So make sure you make all your payments on time. Don't open new accounts or shop for new credit without checking with your loan officer. If your car is totaled and you've got to buy a new car, before you buy the new car, just run it past your loan officer. Okay, my payment's going to be $400 a month. What does that do to me qualifying for a mortgage? You know, don't let us find out about that $400 3 days before closing, and then you don't qualify, and then it's a mess. We don't like creating that for you. So I always tell people what to do up front, okay? Don't change jobs or retire without telling your loan officer. Okay, we're going to check your employment right before settlement. And you may have taken another job with a higher salary and that'd be all fine. But if we find out 3 days before closing, well, now we got to collect new documents and get the loan reapproved and verify your employment again with the other employer. And that can cause your closing to be delayed, which nobody wants. Okay, so just make sure that anything you're doing, your loan officer knows about. And then finally, just check your messages, check your emails frequently, and respond quickly when we ask for information, when your realtor asks for information. Our goal is to have you really bored that week before settlement, not us saying, oh, well, I see you just gave me the statement. Let me see where that large deposit came from, and that kind of thing. So the faster you give stuff to your lender, the easier your process is going to be when you're getting ready to settle, so that you can think about packing up your belongings and not shoving paper at us. Okay. Now, when you're ready to buy, select your lender, select your realtor. I know Wingrove went over what a realtor does. The one thing I would add to that is, we talked about interviewing your realtor. There's a large number of realtors who are very part-time. You want someone who has sold more than one house a year to assist you through this process. So really ask them, how long have they been doing it? Is this their full-time job? Make sure you're comfortable, because they're incredibly important. And then you're going to make your offer. Once you make the offer and it gets accepted, you're going to circle back to your lender to make that formal loan application. They already have a bunch of your documents from the pre-approval, so it won't take long. But there's all sorts of little government questions and boxes that have to be checked. And then we'll confirm to the realtor that, yes, you have made application, because your contract is going to say you have so many days to do this. Okay. You're going to get home inspections done if you're doing those. Generally, we're going to order an appraisal on the property to make sure the value is there. We're generally going to ask you for some more papers. Okay. Once the loan is approved, there's, the underwriter may say, oh, give me this change of address thing or what have you. You're going to shop for and buy home insurance. Okay, don't leave that to the last minute, because you can't go to settlement without it. I generally recommend you start looking for your homeowner's insurance once you have that contract on the home. There can be a lot of variation in price and what the insurer wants. Some of them want to inspect the house, some of them don't. So give yourself plenty of time on that. At least 3 business days before closing, your lender is going to give you a form called the closing disclosure. And that's going to give you your final numbers for settlement and the amount of money that needs to be sent to the title company. And you're going to wire those funds. Okay, the title companies generally don't accept personal checks or certified checks. They require a wire. And then you'll go to settlement and sign your name about 15 million times. And be done. Get the keys, move in. Any questions for me? No questions. Okay. Any questions from any of you here? All right, then. No, he can ask me later. All right, thank you very much. I'll turn this back over to Debbie.
All right, well, thank you, everyone. A great day of information. Like I mentioned, we will be sending out these slides as well as the recording, so you have all that information at your fingertips. And again, thank you for spending Friday with us, and good luck to you on your home search.